Hey everyone, in this video I'm going to bring you 3 ridiculously cheap growth stocks you can buy today. Now that being said, whenever you're looking at ridiculously cheap growth stocks, you want to understand why they're selling at a cheap price. That's because you don't want to fall in the value trap where you're looking at a cheap company, but the reason the company is cheap is because it's on its way down and its prospects are not very good. I don't think that's the case with the 3 stocks I'm going to mention here. I think the risks to these 3 investments are overstated. Therefore, I think they make an excellent investment at current valuations. So without further ado, let's take a look at these 3 cheap growth stocks to buy today.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the 3 growth stocks I'm going to recommend today in this video, the cheap growth stocks are PayPal, Fiverr, and Upwork. And I'm going to compare these 3, or not compare, but I'm going to look at these 3 and share with you several financial metrics that makes me believe that these are good investments, including their revenue growth, their profit margins, their valuations, and the expectations for earnings per share growth over the next 5 years. Let's start with revenue growth, where Upwork leads the 3 here with 14.54% in revenue growth, followed by PayPal, which had 8.21% in revenue growth in its latest quarter, and finally Fiverr, which grew revenue by 5.9%. Now you'll notice each of these 3 has experienced decelerating revenue growth in the last 3 years. However, revenue growth has stabilized since mid-2023 and is actually accelerating slightly here in 2024. Fiverr and Upwork are gig economy companies, and the reason they're selling at cheap valuations are because of the risks that artificial intelligence has on the gig economy platform online. Investors are concerned that people will use AI and AI agents and large language models to do most of the work that is now being done on these gig economy platforms. I think those risks are overstated. I think people will employ other people utilizing AI to complete those tasks. I don't think entrepreneurs will be doing those tasks themselves assisted by AI. Of course, that's my estimation, and the market disagrees. It remains to be seen which of us will be correct longer term. PayPal, meanwhile, has faced falling growth rates as rising competition, a CEO transition, and rapidly shifting consumer behavior hurt the business during the economic reopening. But now that people are normalizing their spending patterns to pre-pandemic levels, that's great news for PayPal going forward. Now, return on invested capital is an important metric I consider when I'm investing in a company, and these 3 have done a great job in improving this metric, especially with Fiverr and Upwork, which you can see here had started at a low level. Of course, growth companies are typically lower on the return on invested capital metric as they expand, as they reach economies in scale so that they can be profitable on the bottom line. And what I like to see from growth companies, from smaller growth companies, especially like Fiverr and Upwork, is continued improvement on this metric, which I do see here. PayPal, meanwhile, is a more mature company. It's been profitable on the bottom line for a long time now, and its return on invested capital at 14.59% has been improving since the last decade. It's not a great number, but it's getting better, and given the shifting consumer behavior in its favor, I suspect its ROIC will improve over the next 5 years. Speaking of the next 5 years, the analysts on Wall Street that are following PayPal stock, they think it's going to grow its earnings per share at 19.45% per year over the next 5 years. That's a robust rate of increase, and that's not a company going down. That's not a company getting worse. That's not a company that's backtracking, right? So I like that its expectations are solid over the next 5 years. It's improving the business, it's focusing on more profitable customers and not just going after any customer. And in the latest 2 quarters, it actually demonstrated growth in monthly active users. And those monthly active users are higher quality now because management's strategy is to go after more profitable customers. Things are heading in the right direction for PayPal. Admittedly, it does face risks, but the company's growing and it's growing profitably. Fiverr International is expected to grow its earnings per share by a whopping 123% over the next 5 years. Now that's coming from a small base, and there's wide variation of the potential outcomes for Fiverr International, but on consensus, the analysts on Wall Street are optimistic about Fiverr's growth expectations over the next 5 years. Of course, if artificial intelligence does end up hurting the business meaningfully, it could go backwards instead of going forwards. However, I think those risks are overstated, as I mentioned earlier. And while I don't think the company will grow its earnings per share at 123% on average each year over the next 5 years, I do think it will grow its earnings per share at a rate that's much faster than the average earnings per share growth of the average company in the S&P 500. And similarly with Upwork, the analysts on Wall Street expect it will grow its earnings per share by 110% per year over the next 5 years. So for Upwork and Fiverr, the earnings per share expectations are extremely robust, and that comes on the back of the increasing convenience of the gig economy. People like to have choice in when they work and how they work, and the gig economy offers that choice. It lets people choose how much they want to work, how many hours, for whom they work for, all of which is empowering, and people are willing to take less money if they have more flexibility, which you don't necessarily have to take less money when you're working on one of these platforms. The big trade-off when working for one of these platforms as a full-time gig is that you don't have the security of a full-time job. That's the big difference. Some people may prefer the security of having a full-time job, while many others prefer the convenience and the flexibility of gig economy work. I know that employers also prefer to have that flexibility and durability when they go looking for people for work. They can choose to hire somebody full-time, or they can choose to go to the gig economy and hire people for specific tasks they need completed. The choice is going to certainly lead to many more businesses choosing gig economy workers instead of what traditionally has been a traditional 40-hour work week, and you hire the person, they have to go through human resources, and all of that is much more inconvenient. And all of that going to say that these companies are ridiculously cheap when measured by the forward price to earnings ratio. PayPal is the most expensive at a forward PE of 13.7, followed by Fiverr International at a forward PE of 8.996 and Upwork at a forward PE of 8.997. Interestingly, the two gig economy platforms, Fiverr and Upwork, are trading at almost identical valuations when measured by the forward price to earnings ratio. That kind of makes sense given that they're both exposed to the same risks and the same growth factors, although Upwork is exposed a little bit more to larger enterprises and Fiverr is exposed to a little bit more of the smaller enterprises, maybe entrepreneurs that hire people for one-off tasks, whereas Upwork might be working with companies that have maybe already 20 full-time employees and they're adding maybe another 5 gig economy workers. Still, it's interesting that they're both selling at that similar valuation. Overall, I think these valuations are bargains for these 3 ridiculously cheap growth stocks, and I already highlighted their earnings per share expectations for the 5 years ahead are robust for all of these 3 that I'm talking about. However, keep in mind there are risks associated with these stocks. There's a reason they're selling at these cheap valuations. These are not no-brainers. These have a wide variety of outcomes that could happen potentially over the next 5 years with very large upside, but also very large downside potential. Overall, I think the upside potential outweighs the downside potential, and that's why I'm recommending these 3 stocks as buys. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.